Morning, everyone.
Yes, Prorector, we are complete.
Good morning. Welcome to all of you. Special welcome to Harina Nguyen. Hereby, I open this academic ceremony in which Harina Nguyen will defend the academic thesis, the effects of peer information and debt governance on corporate investments. May I invite you to present a summary of your study and the conclusions of your thesis. The floor is yours.
Thank you. So I'm going to share my screen. I just want to check if you see my presenting screen.
Yes, we do.
Okay. Dear Prorector, members of the committees, colleagues, families, and friends, thank you for being here today. It is my great pleasure to present to you my dissertation entitled Effects of Information and Debt Governance on Corporate Investment. In the next 15 minutes, I'll introduce you to the overview of my thesis, discuss 3 chapters that comprise my thesis, and the main conclusions. I study corporate investment decisions in my research, and these decisions are made by individuals or groups of individuals who rely on certain information and whose incentives and preferences would determine whether firms pursue certain strategies. For example, if a firm is performing well, and in a sense that it's meeting their targets, I mean short-term targets and medium terms, and there's no major difficulties in the near future, then the managers of these firms don't have much pressure to pursue new investment projects. But to shield the firm or the company from future uncertainties such as new entrants, direct competitors aggressively target their market share, new technologies disrupting the market, then these managers would need to invest in long-term projects such as R&D, M&A, and other market expansion initiatives to be able to consolidate their competitive position. The problem is that financial markets expect the manager to deliver good performance in the next earnings release in the next quarter, not in the medium term to long term, like 2 to 5 years or even 10 years. And we know that pursuing these long-term projects would reduce short-term performance because investing in long-term projects would immediately result in additional expenses that reduce short-term performance. So in my dissertation, I tried to understand 2 major questions around investment decision-making. First one would be, would managers go the extra mile if they are given the opportunity to be less susceptible to this short-term pressure? And the second one would be, would this pressure, would they pursue more investments if they have more information disclosed by their peers? In chapter 2, I specifically investigate the effects of managers' preferences on these decisions. In normal conditions, managers, to some extent, need to fulfill his or her duties to shareholder by meeting short-term expectations. But ultimately, the role of a manager is to maximize the shareholders' wealth. And most likely, wealth maximizing projects fall into medium to long term. And these managers would need to balance the need to deliver short-term performance while pursuing long-term projects, so to ensure that they remain competitive. So to gauge into this preference, I use a CMR setting in which firms are required to keep their top management by creditors. By the way, CMR means change in management. It's a restriction on change in senior management. And CMR make it difficult for the board of directors to terminate senior executives for underperformance, because doing so would trigger a technical default, which means that The creditors now have the right to accelerate loan repayments or renegotiate the debt contracts in more favorable terms. Ex ante, it is unclear whether CMRs would result in more or less investment. On the one hand, managers are protected and they may exert less effort in making difficult decisions such as pursuing long-term projects. On the other hand, now less pressure by short-term expectations, they can endure a dip in short-term performance and prioritize long-term projects. To be able to test these conjectures, I hand-collected a comprehensive set of CMR data, which includes not only a starting date of these covenants, but also following years until they become inactive. And I use several proxies for managerial efforts such as R&D, acquisition, CapEx, and other decisions such as advertising expenses or hiring and firing decisions. What I find is that managers exert less effort in the presence of CMR by showing lower investment, less hiring and firing, higher expense, which is interpreted as potentially less negotiation with suppliers. In short, they prefer a quiet life. In Chapter 3, I examine the role of financial accounting information in making investment decisions. More specifically, I examine the effect of voluntary disclosure called non-GAAP, which stand for non-compliance with generally accepted accounting principles. It's interesting to see whether these disclosures are also informative for peer firms. Because these are additional disclosures intended to inform shareholders on the economic performance, they may not be fully reflected in GAAP. They may contain some useful information for peer firms. As I said, non-GAAP disclosures can be useful not only for shareholders, but for peers for several reasons. First, additional details on exclusion from GAAP is useful for peer firms to learn more about the non-recurring or non-cash charges that may not be available in GAAP numbers. Second, the decision to exclude certain items is discretionary. Thus, non-GAAP reveals managers' perspective on how they evaluate their performance internally. Third, combining many of these disclosures can help peer firms to form a more accurate picture of the industry conditions that may not be available when they consider them individually. The reason why I find this research question interesting is that non-GAAP disclosures are increasingly used by public firms. However, as non-GAAP disclosures are intended to provide shareholders additional information, we didn't know whether information from these disclosures would also spill over to peer firms. Although we can agree that a non-GAAP less likely contain proprietary information. Additional information may reveal managers' certain view towards their internal performance. And finally, prior research shows that non-GAAP disclosures can be informative or opportunistic. So it's interesting to see whether the spillover effects, if we find any, are of positive or negative in nature. It should be noted that as there was an increasing attention from regulatory body on non-GAAP disclosures, these disclosures are required to follow certain guidelines. Thus, they increasingly become informative in recent years. So in this paper, I perform a regression with non-GAAP variable at the industry level. However, as the industry variable might be correlated with unobservable other industry variables, I also conduct additional tests using pairwise structure in which peer firms are selected from TNIC classification. What I find is that the investment levels are higher for firms with high peer disclosures. Additional tests shows that the effects are more pronounced when firms operate in environment with higher uncertainty. However, when the information is of higher quality, the effect is less pronounced. This suggests that the non-GAAP disclosures may be used as substitution in the environment when they have scarce information. In Chapter 4, I analyze the different types of disclosure which are mandated after M&A transactions, merger and acquisition transactions. Specifically, I investigate how the allocation of purchase price or purchase price allocation, abbreviation is PPA. I'm going to use PPA later, going forward. So I investigate how the disclosure of PPA by peer firms in the merger and acquisitions influence the corporate investment decisions of focal firm. Under current accounting standard, intangible investments are often expensed and incurs. However, after M&A transactions, acquired firms are required to disclose intangible assets that are not recognized as goodwill. So this is a unique setting which reveals additional economic value of these investment intangibles. Without PPA disclosures, these items otherwise end up in the P&L, revealing little information about future earnings generation potential of these investments. This research question is particularly interesting because intangible assets are increasingly important in the current economy. Also, it contributes to the debate as to whether this should be expensed or capitalized, and to what extent we can do so. Ex ante, it is unclear whether peer intangible asset disclosure would have an effect on focal firm investment. On the one hand, these materialized intangible investments show peer firms that the technologies they are pursuing are feasible. On the other hand, the success of these investments can also deter peer firms from making additional investments if they think that the acquirer can capture benefit from newly acquired assets. I test the hypothesis using regression in a pairwise structures to be able to gauge the direct effect from these PPA disclosures on the focal firms in investment. What I find is that peer firms increase investment, and this suggests that these peer disclosures of intangible assets can potentially be used by peer firm. Moreover, additional analysis shows that the effect found is not dependent on earnings quality, as information is already credible. Finally, another cross-sectional analysis shows that the effects I found more pronounced when the target is more profitable one. To conclude, this dissertation examined the effects of agency conflicts and peer information disclosures on corporate investments. Evidence from Chapter 2 shows that CMRs potentially induce additional incentive misalignment between managers and shareholders, and this result in lower investment levels. In Chapter 3, I find that peer information, especially non-GAAP disclosures, are largely useful for making decisions of the peer firms. Moreover, the intangible asset disclosures are also useful in a similar way. The dissertation contributes to the understanding of the spillover effects of financial disclosures, especially non-GAAP and PPA, which have not been research from the peer effects perspective extensively. Findings are also useful for managers to consider whether making disclosure decisions, such as revealing additional exclusions from non-GAAP, and whether these will be beneficial for the shareholders comparing to adding information to the peer decision making. Also, they can also use this to learn more from peers so that they make more informed decisions and reduce the uncertainty in their decision-making process. Moreover, my dissertation also contributes to further understanding the consequences of newly discovered CMR practice within the academic circle, and it highlights its impact to debt holders and shareholders. And with that, I conclude my presentation. Thank you for your attention.
Thank you, Harry, for your presentation. I think you can stop sharing your screen now. And then we will start with the opposition, and the opposition will be opened by the chair of the assessment committee, which is Professor Dr. Anne van Stralen, and she's Professor of Accounting and Assurance Services at Maastricht University. Professor Anne van Stralen.
Okay, thank you, Rector. Dear Harry, first of all, congratulations with finishing your dissertation, and the job well done. But as you know, my task today is to ask you a couple of questions. So my question relates to the consistency of your findings and the consistency in the research design across the 3 studies of the dissertation. With regard to the consistency of the findings across the studies, so in your chapter 5, where you discuss and summarize the findings of your dissertation, you conclude that, and I quote, the evidence on the negative spillover effects suggests that managers can further learn from peer firms if they can distinguish high quality from opportunistic disclosures. And I think this conclusion nicely aligns with the findings in your study too, where you show that the effect on investments from peers disclosing non-GAAP numbers is stronger when the non-GAAP earnings are actually more opportunistic, so which implies negative spillover effects. However, this does not seem to align with your study 3, where you conclude that the effect of intangible asset disclosures on peer firms' investments does not vary with the earnings quality of the acquirer. So how do you align these findings, or are the findings of study 3 very specific as they relate to the purchase price allocation process, which cannot really be generalizable to other sets? And then with regard to the consistency of the research designs, and more specifically the functional forms across the studies, I noted that in the 3 studies, you use investments in year T+1 as your dependent variable. And in study 1 and 3, you control in the analysis for the level of investment in year T, which appears to be highly significant. However, in study 2, where the level of investment in year T+1 is your only dependent variable, you do not control for the level of investment in year T. So can you explain why you don't include this and why this does not result in functional form specification concern? And actually, more generally, I note that other control variables are also not consistently used across the chapters using the same dependent variable. So I was wondering what's the reason. I look forward to your reaction. Thank you.
Highly esteemed opponent, thank you for your kind words and your questions. So you have 2 questions, and I'd like to address the first question in terms of the consistency in the findings that we have for two papers. First one is the examination of the effects of non-GAAP disclosures on peer investment, and the other one is the effects of intangible disclosures. And you are right that the findings are different. The conclusions are different in these two studies. So the first one, I investigated the non-GAAP and what the prominent characteristic of non-GAAP that we found in the literature and also in practice is that because it's entirely discretionary, then managers can decide to exclude certain items and include certain items. So the characteristic is that they can be informative or they can be opportunistic because they are voluntary disclosures. Then I find that if they are likely to be opportunistic in one of the tests, this would lead to a negative spillover effect. The difference in intangible disclosure is that these are required by the regulatory body. So the process of coming up with this with these disclosures are quite different. So in the PPA process, then there are many consultants involved, and they going through the process to allocate these intangible investments to see whether they belong to goodwill or they belong to a category that can be disclosed in this PPA. So I would think that the requirement for the intangible disclosures are higher, and that's the reason why we have reason to believe that it's more quality or higher quality. They are more informative, and it's consistent with one of the findings that I find that the effects are not varied in the earnings quality test. And coming to the consistency of the design, so in the non-GAAP paper, let's talk about the intangibles first. Yes, so the analysis that I use in this the test for the intangible disclosure paper on peer investment is that I conducted the analysis using pairwise regression method. And one of the problem in conducting this design is that if I include the firm's fixed effects into the regressions, then I would eliminate most of the variations. And to be able to improve the design, I included the lag variable of the investment to be able to see whether the effects is actually driven by these intangible disclosures. So that's a limitation, and that's why I included this to have a better control for my design. In this in the peer non-GAAP disclosures, the design is a bit different. It's not pairwise regression. And what I try to do is to see whether the investments are dependent on non-GAAP. So what I did there was to control for the industry fixed effects and year fixed effects. And one of the issues is that because non-GAAP is quite sticky, then I couldn't use the firm's fixed effects as well. And that's what so those two things in terms of design lead to my choice that in the intangible asset paper, then I control for this firm's investments using the lag variable. But on the other paper, I use the industry fixed effects to control for this effects. Of course, I acknowledge that they are not perfect, but those are the solutions that I come up with to be able to improve the research designs of the papers. I hope that answers your question.
Thank you.
Thank you. The opposition will be continued by Professor Dr. Erik Peek, who is Professor of Financial Reporting and Valuation at Erasmus University, Rotterdam. The floor is yours.
Thank you, Rector. Dear Harry, let me also start by complimenting you on the job well done. I think your dissertation presents a nice selection of empirical studies, and it was a pleasure reading it. At the same time, like my predecessor, I also have several questions. And I would like to start with a question about chapter 2. And so in chapter 2, you examine the effect of management change restriction covenants, or CMRs, on investment levels. And the prediction that you test is whether these CMRs affect investments through their mitigating impact on managers' career concerns. And you find some evidence that they do. Now, your predictions raise a few questions, and two of which I would like you to reflect on. And so first, I observed that you study these CMRs in isolation, thereby ignoring that there might be other covenants in the company's debt contracts. And then this surprises me a bit, as I would argue that it is the set of covenants that aims at optimizing the state contingent allocation of control rights, and not just one single covenant. And so my question is, what is your expectation about whether and how the presence of these CMRs affects the other covenants in the debt contract, especially if we assume that debt contracting might be incomplete but largely optimal in giving lenders decision rights when this is needed? And how does this expectation actually align with your current predictions and your current findings? That's the first question that I have. The second question is related but slightly different. Your predictions ignore risk-taking effects. Whereas you can expect, and especially based on prior studies, that career concerns also affect risk-taking. And so can you justify that choice? Or more broadly, my question would be, can you examine investment efficiency like you do without considering investment's effect on risk? And for example, I can imagine that a quiet life can also be accomplished by making more risk decreasing investments. So can you reflect on these two questions for me?
Highly esteemed opponents, thank you for your kind words and your questions. Your question actually tracks to the very core of the research questions that I did, and it was also discussed constantly in our research team. So let me talk about the second question that you asked, which is whether I ignore the risk-taking perspective and how does that affects the efficiency of this investment. So the main point of this is to find out whether there's an immediate step in which CMR is imposed, and then how would that affect the decisions. So we have a blanket expectation of the fact that if there's something happening, then I would expect that to change and that lead to the changes in investment behavior. And then your questions coming into the second part is to see whether one type of the decision changes, so the investment change, and whether that's a risk-taking decision or whether that's a risk-decreasing decision. So I was trying to find out this as well. And the problem is when we talk about the efficiency of these investment decisions, then we have to come back to the question is whether the firm would want to invest in certain projects or whether these firms have something to divest, meaning that they want to get rid of some of the investments. Then ideally, if I was trying to find data to see whether I can split this into firms that want to have a higher investment in certain area and firms have the need to divest. but the limitation of the study is that this sample is quite small, and I was not able to find enough data on whether these firms have certain tendency. So yeah, if we can have a more granular data on this sort of behavior, then that's a good test that I would like to do as well. And coming to the first questions about other covenants, you are right. I was trying to single out the effects of CMRs, and I think if we talk about the covenants, then any private contracts have a certain standard set of covenants. So, for example, if they would like to have a private debt contracts, then you have financial constraints covenants. You have a certain blanket application of these covenants. Then, if we control for these sort of covenants, then I would argue that we would have, because we already have a similar set of firms, then we would find the effects of other covenants also embedded into this already. Then if we that's why if I'm only interested in the CMR settings, then basically I just use this balanced samples, because the only difference that they have is whether they have this CMRs or not. Then I would also be able to single out the effects of this CMRs without adding these other covenants into the mix. I hope that answers your question.
Can I briefly follow up on that? So
Sure,
it seems
yeah.
like the answer to the second question essentially is that the choices that companies make around these other covenants are relatively random, and so they're unrelated to the CMR. I would expect that that's not the case. So I would expect that if you have a CMR, then it's probably more likely that you have more tight performance-related debt covenants, such that you can more easily step in when that is necessary. So my follow-up question would be, okay, if that is the case, how would that change the picture?
Yeah, thank you for the follow-up questions. I agree that if we're talking about whether we can vary these covenants in the degrees that they are imposed. For example, if we know that performance covenant covered certain limit, and we have the extent to which how much or how the magnitude of this governance, then of course we can also control for this in my study, and that's a good choice. The study that I do in the CMR without controlling for the variation in this governance or the magnitude of this governance, then I think it represents a minimal effects of these CMRs. And if we have this into consideration, then we would be able to have a more granular analysis, so that if we know that the performance is this much and we control for this, then I would think we have a better picture, and that I absolutely agree with you. Why? Because I hand collected this set of data. I actually went to each individual debt contracts and covenants. So I saw a little bit of what covenants are in there, and it was, at least to me, it was not easy to collect all the details of the covenants, given the massive amount of debt contracts that I had to go through.
Okay, thank you.
The opposition will be continued by Professor Dr. Maximilian Müller, also member of the assessment committee. Professor Müller is Professor of Financial Accounting at the University of Cologne. It was yours.
Thank you very much. Harry, congratulations to a fine piece of research. The results are very insightful, but sometimes they're not conclusive and lead us to ask better questions or different questions. So I have two. Regarding your first paper on CMRs, you find that there's a lower investment for firms with CMRs and interpret this as supporting the quiet life hypothesis. But then you also document that there is no difference in performance. That made me wonder, how do you explain this result? Is there a benefit that you don't yet capture? Do CMRs make the existing factor inputs in some form more productive? Maybe you can share your thoughts on that. That helps us reconcile these results with each other. Regarding your second paper on the non-GAAP earnings, you find that firms react more strongly to non-GAAP earnings that are more positive, which reminded me of the Beatty et al. Paper that finds that peers react to the fraudulent reports of other peer firms by increasing investment during fraud periods. Do you have any ideas on what could be done to assess whether it's actually good for the firm to use peer firms' non-GAAP earnings in their decision making? Can they see through opportunism? Can you think of tests that could help us get at this question, whether they should rely on these types of non-GAAP disclosures? Any thoughts that you might have here would be super interesting. Thank you very much.
Highly esteemed opponents, thank you for your kind words and your questions. I'd like to address the first question, which is about the CMR paper and whether this would lead to changes in the performance. I would like to direct my answer towards a test that I did in the paper, which is a test about performance. Of course, you are right that I don't find any effect in the operating cash flow test and also the profit, the ROA. But I find the CMR is associated with a lowest level of sales and also tubing kills. So my conjecture is that when we talk about some changes, then it's very likely that it's going to affect the sales level first, because in the equation, if we talk about the profitability, then we need to also look at the expenses and to see whether that translates into a different level of profitability. So that bit of evidence would reconcile with the findings that I see in investment, that they reduced investment and also the sale levels went down. You are right about the profitability. So I would think that when we talk about profitability, it's unlikely that the performance would translate right away in the next year, and it needs to take a bit of time. For example, like 2 to 5 years to be able to see the effects of this. Actually, I did additional analysis on the next 3 years, and the results were still insignificant. So I don't find the effects in the next 3 years. But also because there are many things that happens when we talk about an impose of CMRs and we look further into 3 to 5 years, then there are many factors that are coming in between as well. So although I find that, I don't think it's very conclusive of whether the effects of CMR will translate into performance. And what I would like to do is to find a more direct mechanism to be able to pinpoint this performance. But that's something that we can do in the further research as well. In terms of your second question about the non-GAAP paper, I agree that when we have what's so-called opportunistic non-GAAP disclosure, then it's likely that we expect to have a negative spillover effect, and this is documented in other disclosures research as well. what the difference in non-GAAP disclosure is that when managers disclose their non-GAAP, it's not like a single number saying this is not a GAAP and this is non-GAAP. They have to reconcile these numbers to the GAAP. So there are details about what exclusion they included, how much they include. For example, if they have goodwill impairment and they want to include this in this non-GAAP reconciliation, then there are additional information so that we can see through sort of whether this makes sense. And for example, if you are in an industry, you understand the industry, and you also understand certain non-cash or non-recurring items are common or not. So if you think that this is not common, this is not non-recurring in our industry, then you can see it through right away. And I was trying to do this as well. The problem is also coming with the data collection. And subsequently, I think in the last year, because I was out of academia for a year now, and I look back, I think there are additional efforts on collecting all this information, and hopefully the data can be available. So then we can run an analysis and we match certain or we match this to the exclusion categories. Then we can have a more direct mechanism of whether this is something that is reasonable and how would that affect the changes in the investment. And I hope that answers your question.
Yes, very much. Thank you.
Thank you. The opposition will be continued by Professor Dr. Peter Sampers, also member of the assessment committee. Professor Sampers is Professor of Financial Accounting at Maastricht University. The floor is yours.
Yes, thank you, Paul Rector. And first of all, Harry, congratulations with finishing your dissertation. It's a nice piece of work, and I've read it with interest. Notably, the study in chapter 4, that's not specifically because of the, let's say, accounting background, but because I used to work in a research and development environment earlier in my career. So that always attracts my attention to some extent. Now, in that study, you start more or less from the premise that most intangible assets are investments are expensed in the first year. And I quote, "This can obscure important information about the ability of those investments to generate future earnings." And there you follow, let's say, the views expressed by Baruch Lev in quite a number of publications that he has, and he's known as a long-term critic of the accounting model that we have for intangibles. Now, I was a bit surprised that you do not critically assess that view, because there are also opposing views. I recall that Steve Penman wrote an article in Abacus in 2009 already, and it has the self-explanatory title, Accounting for Intangible Assets, There's Also an Income Statement. And what Penman has been arguing is that the information on expensing R&D may be just as informative as the information that is captured by the balance sheet items that are recognized as intangible assets. So, and not only Penman was perhaps early to make that comment, we also saw empirical work more recently, amongst others by Tammy Din and Wolfgang Schulze, who published a study in 2022 that actually also showed that the information on R&D expense flowing through the profit and loss account is actually informative for decisions of investors, and then probably also for peers which you are investigating. So that leads me to the following set of questions. The first, why do you think that balance sheet recognition of intangible assets will be the driving factor also for peer decisions that you investigate with respect to investments in your study? Secondly, which consequences would the alternative view of Penman, so that recognition in the income statement is relevant, have for your research design in the study that you conduct in chapter 4? And lastly, in chapter 4, you look at the PPA and the intangible assets that arise from the purchase price allocation. The variable you use there is total net intangible assets. And I could not really see whether that total now comprises both goodwill and other intangibles, or if it is only the other intangible assets. And the question why I was curious about that and why I would like to understand your reasoning in this respect is that you might perhaps argue that the informative nature of goodwill is different from that of other intangible assets that are recognized in the PPA. So those three questions I would like to hear your views and reflections on.
Highly esteemed opponents, thank you for your kind words and your questions. One thing I have to agree with you is that the third paper, I would say the fourth chapter about intangible is something I'm really passionate about as well. It is not good in terms of objectivity of a scientist, but that's something that drives me to do or to learn a lot about this in my last year of the PhD, and I really enjoyed it. Coming back to the questions that you have, and I also agree with you that the P&L and the balance sheet goes together. So it's more like two sides of the same coin. So if we see P&L, we can predict a little bit of what's happening in the balance sheet. But I would not say that it's mimicking one-to-one. And the reason I'm saying that is that if we look at the current economy, then it's totally different from what we had in the 2000 or 2010s. We used to have a lot of manufacturing company. So we have a lot of physical assets, and investment in intangible or in R&D requires a lot of capital acquisitions, which is also different from what we have here. Now a company in a new economy can just hire a programmer with a team of 5, and they can build a company worth $1 billion within a year. So would we consider these expenses as intangible investments, or would we consider them as expenses in a traditional sense? That's a problem that we are coming at, and that's why I find this debate is very important. I'm an accountant as well, so I think both sides have their merits, but they need to come together and agree on certain extents. Then the next point I want to go back to the reality of what we have now is that we are transitioning from a tangible economy to intangible economy, and things like what expense in the SG&A may not necessarily be fully expensed. Some of them have a very intangible values that will be materialized in the next 2 to 5 years. And if we look at these expenses, then we don't know whether part of this is already materialized in intangible assets, or whether some of it will be just like an expense that we have within 1 year, right? That's why if we look at the full P&L, then we can't distinguish this. If we look at the disclosure on intangible assets, then we have additional information on this. We know that for some reason, they agree that some of the expenses have materialized to the next stage. And that's what I'm really interested in. And that's additional information that we can get from the balance sheet. And I don't think it's fully reflected in the P&L. Coming to your second questions, I think I actually answered the first and second question at the same time.
Yeah.
So the third question would be, you're asking about the total investments. In this, I think the way I construct this investment is by using the total of R&D, and I think I included CapEx as well, just to measure for the total, to gauge into this the total reaction the main analysis also would be the R&D, peer R&D, because basically that's something that I'm interested in, and also the peer invest SG&A. But I don't think in the peer investment would include goodwill in this. So yeah, and maybe because I include other things into this peer investment, that's why in some of the tests I don't see it very highly significant. Yeah, that's my initial impression of this. And I hope that clarifies your question as well.
Okay, that clarifies my question. Thank you for that. And I'm happy to note that you also see that the balance sheet and the profit and loss account are interconnected. So we're back to, let's say, basic bookkeeping, and that's the basic notion that Pacioli already taught us. So thank you for that comment.
Thank you.
Thank you. The opposition will be continued by Professor Dr. Stephanie Kleinmeier. She's professor of entrepreneurial finance and banking, both at Open University and Maastricht University. Stephanie, the floor is yours.
Yeah, thank you very much. Dear candidate, dear Harry, so let me first of all join my colleagues and congratulate you on an interesting and relevant dissertation that you have delivered here for us today. As my title says, I come to this dissertation with a finance background, both in corporate finance, but also bank lending. So I found it very interesting to read about topics I'm also interested in, loan covenants, corporate finance decisions, but to see how accountants take a point of view that is very different than I as a finance person would approach this. So I definitely learned something from your dissertation. So yeah, with that in mind, let me move to my question, which is about chapter 3, where you investigate the relationship between these non-GAAP earnings and or these disclosures of peer firms on the focal firm's investment decisions. And when you develop your hypothesis, so that's in the electronic version, that's on page 62, you tell us about two choices that the firm has under uncertainty. You say, well, either the focal firm can decide not to invest, but to wait for further information. And here the disadvantage is that the firm might miss valuable investment opportunities. And the alternative would be that the focal firm can decide to invest now without having further information. And here the trade-off, of course, is that you might make suboptimal value destroying investments. And then, as you get to your hypothesis, you say non-GAAP earnings are on average informative. And your hypothesis then predicts that investment levels are higher for firms that operate in industries with a higher percentage of peer non-GAAP disclosures. So, your main proxy then is also the percent of firms that in this industry that have these non-GAAP disclosures. So when I read that, I was a bit puzzled how you can have a directional hypothesis, you're saying higher investment levels, without taking the information content into account. So the percent of peer firms that have non-GAAP disclosures tells me nothing about what these non-GAAP disclosures are. How are they? What information do they disclose, compared to the debt disclosures? And do they indicate sort of a positive or a negative investment climate, given these two choices I had before? So, what exactly do these managers learn from these peers? How does it help them making this choice? Invest now, yes or no? So how do I know that, I should be investing more, or now instead of later? Why should I not just take the other alternative and say, no, I'm not going to invest now because it would be suboptimal? So I'm looking forward to your answer.
Highly esteemed opponents, thank you for your kind words and your questions. This is also a core issue that we in our research team discussed a lot about the informational value of this non-GAAP. And as I mentioned before that in this non-GAAP disclosures, we have this exclusions items that should be informative to whoever interested in the performance of these firms, whether it be shareholders or other managers. And the reason that we had this directional prediction is based on an assumption that we observed from the recent changes in the non-GAAP. I have to admit that this assumption is a strong assumption, but given in the recent development, the SEC have been increasingly involved in providing guidelines to these firms, whether they have to provide certain non-gaps, then they have to reconcile them. They have to disclose the gap first and then non-gap. So they are very detailed in their guidelines, and they also in recent years they also go after the firms that are not compliant with these guidelines. So from that assumption, we sort of assume that it's on average informational. Coming to your second point about whether because the coming back to the hypothesis, and the hypothesis development is that whether they should wait or whether they want to make an investment decision, which one is optimal, right? So in this sense, we still don't know. What we know is that if they decide that it's useful and it reduces the uncertainty in their decision making, they would invest right away. Then if this is the case, then I would expect the investment levels higher to some extent. And coming back to the combining the hypothesis development and also the informational contents of non-GAAP disclosures, then if they have additional information and we know that this information are becoming increasingly credible, then it resolves the uncertainty in their decision making. And to some extent, I would expect some changes in the investment of the peer firms to the positive side. I also agree with you that if we look further and we see beyond the percentage of non-GAAP in the industry, then we can also look into percentage of certain items and whether these can be attributable to the changes in investment. That's one thing that we can do. And to resolve a bit of like a broad level proxies of the percentage, I also did a pairwise regression as well, in which I look at these firms not as a percentage, but actually in a very close circle, that they are classified as pair. So if one disclose non-GAAP, would I expect something changes in the peer as well? So like the direct relationship, and I try to mitigate the weakness of the percentage measure that you mentioned with this pairwise regression. And I hope that answers your question.
Yeah, thank you very much. I think we could discuss endlessly, but I want to give the last 2 minutes to the final member of the Corona for very quickly asking his questions. Thank you.
Yes, indeed. So let's continue the opposition with Dr. Apoorv Gogar, Assistant Professor of Financial Accounting at Maastricht University. 2 minutes left.
Thank you, Prorector. And hi, Harry. Good to see you. To avoid in the last 2 minutes, to avoid adding any undue variation, I would continue with the flow of the opposition, and first would like to congratulate you for successfully completing your PhD dissertation, arguably one of the more significant accomplishments in our field. And I really enjoyed reading your PhD dissertation because it also deals with a topic that's close to my heart, which is bank lending and debt contracting. So I would straight away get to that, which is there was one issue which was sort of puzzling to me as I was reading, and I'm quite hopeful that you can help me wrap my head around it, which is that it seems that these debt contract, like the terms and covenants that are included in the final lending agreement, are a result of negotiation between the syndicate lending members as well as the management team of the borrower. So, and from your discussion, it seems that both the lenders and the management are better off with the inclusion of the CMR clause, right? At least theoretically, conceptually. So then I was a bit puzzled why we empirically observe only 3 to 4% of the loan contracts have these CMR clauses. So what explains that? Like, what's the cost, if any, of including these CMR covenants? Why are they not always included in the loan contracts? Thank you.
Opponents, thank you for your kind words and your questions. And it's good to see you. Could I
Take
be
1
able
more minute
to-
to answer this question very briefly, and then we
Thank you. Yeah. So I think that the main takeaway, and I was thinking about this issue as well, and the main takeaway is that this sort of covenants is costly. So if you impose these covenants on the firms that you're lending, there's a risk that the shareholders can also file a lawsuit saying this is not compliance with our agreements between the shareholders and the managers. Then it is not without cost. And I think that's one of the reasons that this is not a blanket covenants like some of the other covenants that we normally see about performance or about the financial constraints. But this is also risky for the syndicates. And I hope that answers your question.
It does. Thank you.
Harry Nguyen, the time appointed for defending your thesis has passed. The decree committee will now withdraw to discuss the quality of your thesis and your defense. I request that you and your company await the results of our deliberations and our return. Harry Nguyen. The degree committee here present online has assessed the quality of your thesis and your defense. In line of its positive verdict and taking into account your previous qualifications, the degree committee has decided to grant you the degree of doctor. Professor Renders is authorized to confer upon you this academic distinction in accordance with Dutch university custom. I invite your supervisor to now take the floor.
Harry, do you promise to work in accordance with the principles of scientific integrity at all times, and to be careful and honest, transparent, independent, and responsible?
Yes, I promise.
Then, by the authority vested in us by law and in conformity with the decision of the committee here present online, I hereby confer upon you, Harry Nguyen, the degree of doctor and grant you all rights attached by custom and law. And as evidence of this, you will soon receive the degree certificate signed by the rector, the secretary, and the supervisor, affixed with the official seal of the university, shown by the beadle.
Thank you.
Congratulations. So, dear Dr. Nguyen, dear Harry, today I have the distinct pleasure to be the first to congratulate you upon obtaining your doctor's degree. And I think you've done more than an incredible job. You've juggled work, family, and dissertation, all while probably consuming enough coffee to keep a small coffee plantation profitable. And I would like to add a small note to the audience here. Since Harry worked at a coffee company in Vietnam and can converse hours about coffee and how to make a perfect cup of coffee, I've tried to put in as many coffee hints as possible. And hopefully this will keep you awake during my laudatio. So it is my job now to reflect a bit on the journey that brought you here today. And this journey started with me obtaining a VD grant. Against all odds, the Dutch Research Council decided that my accounting ideas were worth funding, and suddenly I needed to find 2 PhD students who didn't mind joining an over-enthusiastic professor to investigate accounting topics. So, as normal, I wrote a job opening for a PhD position, and you were one of the many students who applied for it. Now, based on your CV and your motivation letter, I decided that I would like to have an online meeting with you. Now, this first online meeting already convinced me to hire you. You not only understood the grind, and here's the coffee pun intended, of pursuing a PhD, but you also brought a more mature and grounded perspective. You knew very well why you wanted to pursue a PhD, and you were actually the only candidate who asked me questions about the research proposal itself. In addition, you came across as a very mature person. And I only realized later that part of this was due to the fact that you were already married and had a baby. And to date, I still admire that you decided to move your whole family from Vietnam to pursue a PhD in the Netherlands, a country that is famous for its cheese, windmills, and tulips, but not so much for the quality of its coffee. As is custom in Maastricht, I needed to find a second supervisor for your PhD. And finding a second supervisor is kind of similar to finding the perfect brew for your coffee. So originally, Matthijs joined us, becoming part of an excellent team that enjoyed brewing up some good-natured fun, mostly at my expense. Unfortunately, Matthijs decided to leave academia after 1.5 years, and when Matthijs left us, Patrick stepped in. And Patrick proved to be the kind of co-supervisor who was always there, ready for a chat or to spill the beans on the latest accounting research. And I would like to make use of the opportunity to thank Patrick for being such a great co-supervisor. And I have to admit that I miss our coffee conversations in Maastricht. And I also would like to thank the members of your Corona, Anne, Peter, Erik, Max, Stefanie, and Apurv, for taking the time to read your dissertation and asking their tough questions today. Now, more than a year ago, Harry, you decided that you didn't want to stay in academia after your PhD. And so when you were offered a job at Allianz, you decided to quit your PhD earlier and move to Munich. And this decision was mainly driven by family reasons, as you don't want to put your family through the uncertainties associated with finding a tenure-track position and the stress of getting a tenure. And your decision to move from academia to the industry is as respectable as it is bittersweet. I think we have lost a great academic, but then again, you need to choose the path that suits you best, as life is too short for a bad coffee. Throughout your PhD, your research showcased your ability to identify and explore unique settings. Your talent for spotting the perfect blend of data and theory is unmatched. Although at first glance you may come across as a mature and quiet person, you have a great sense of humor and a warm personality. I think you're actually one of the first people who are able to handle Patrick's jokes and give him equally fast replies. You are extremely quick-witted, and you deliver most of your jokes with such a straight face. And although I usually don't laugh until I've had my coffee, your humor has often been the exception. You're also liked by many people in the department, in the PhD office, and at conferences. I remember when you attended the doctoral colloquium at the EAA in Bergen, where you also met Max. Many people came up to me afterwards telling what a friendly person you are. Your good-natured and stable personality also managed to calm things down when the stress levels would peak in the PhD office. There are not many things that would throw you off your feet during your PhD. Dear Harry, your journey from your own coffee company in Vietnam to a master in Australia, to a PhD in the Netherlands, and finally to a job in Germany has been as rich and bold as a well-brewed cup of strong black coffee. Congratulations again on your achievements today, and I sincerely hope that in the future we will be able to drink a cup of coffee again together. Well done.
Thank you very much, Annelies.
Dear Dr. Harry Nguyen, also on behalf of Maastricht University, I congratulate you with the degree you have acquired. I hereby declare the ceremony ended. And I would like to invite the Beetle to congratulate you.
Congratulations and all the best for your future. You did it perfect. And enjoy your later day.
Thank you very much.